Welcome to Business Tips with Michael Tobian. Today's topic is getting started with taxes. Taxes is a huge topic. So huge, in fact, that regardless of the financial know-how of a business owner, companies hire certified public accountants to handle their taxes for them. So huge, in fact, that an entire YouTube channel could be dedicated just to taxes. The advantage to having a CPA do your taxes is they stay up on all the current regulations and they're able to limit your tax liability as much as possible so that you don't overpay the taxes you owe. It would be very difficult for you to stay up on the new tax regulations as much as a certified public accountant would. I'm not a CPA or an accountant at all, so I'm not giving any accounting advice to you. However, I've been around the block and I'm going to share with you 5 things to keep track of in your business expenses for taxes. When it comes time to do your taxes, you may be glad that you did. Number 1, all business-related expenses. I had somebody once ask me, what is the tax advantages of owning a business? While I felt this was somewhat of a loaded question, I told this person that I felt like the main advantage is that you can write off business expenses. As an example, a W-2 employee is not able to write off business-related mileage to and from work. However, if you own a company, your CPA may advise you that your business-related mileage can be considered an expense against your profitability. Well, that lowers your reported income, and thus it lowers your tax liability. Some of these business-related expenses are somewhat of a gray area, where you and your CPA will decide if the expense is business-related or a personal expense. With some expenses, you can make an argument that it would go in either direction. I have a friend that once told me that he says to his accountant every year that if there's any chance of his business being audited and them looking at the business-related expenses and it not passing an IRS audit, that he shouldn't include it as an expense. He doesn't want the stress of having to defend those gray areas with his expenses. He would rather just approach his tax deductions with caution and perhaps be on the side of paying a little too much taxes than risk the possible audit going wrong. If he experiences an IRS audit, he just wants to freely turn over his books and have a nice little pat on the back from the IRS that said, you did a great job with this, and they have no disputes. Some business owners who are very aggressive like to deduct lots of things, and sometimes things that they may or may not be able to defend in an audit. Whichever direction you go, aggressive or conservative with your deductions, it's always a good idea to keep track of possible business-related expenses and then have a conversation with your accountant as to whether or not that is an appropriate expense to deduct. The second thing I'm going to suggest that you keep track of is your business mileage. So the IRS allows you to deduct your business-related automobile expenses on your business tax returns. As an alternative option, they usually allow you to deduct a monetary amount per mile in lieu of itemizing and deducting all the automobile expenses. So you can usually do one or the other. You add up your mileage and do that calculation of the IRS allowed mileage deduction, or you can just keep track of all your automobile expenses. I have a friend that had a locksmith business, and he calculated that his usage of the IRS allowed mileage deduction was a much better deal for him than itemizing all his automobile expenses. In fact, he was able to deduct more money through the IRS allowed mileage deduction than he actually even spent with his automobile expenses. So that ended up being an advantage for him. He drove an older car that was very reliable. He didn't require a lot of maintenance. It wasn't a fancy car. He didn't spend much money on it. He was able to come out on top because of the IRS allowed mileage deduction. Number 3, you should keep track of what your salary is. As a business owner, your CPA may advise you to give yourself a W-2 salary. In this situation, some of your business income may be considered your salary, and some of it may be considered a dividend. It's sometimes possible to limit the amount of FICA taxes that you owe by strategizing with your CPA about the appropriate salary that you give yourself versus a dividend that you take. That's a conversation between you and your CPA. Number 4, you should keep track of the dynamic regulations and updates that the IRS has every year. Each year, the tax code changes slightly. Politicians raise and lower tax rates. They change tax credits that you can take advantage of. They update deduction rules and things like that. So if you have a good CPA, they will stay up on all these major changes that the IRS makes. So make sure your CPA knows everything possible about your business. You may be benefited from IRS updated regulations. Some examples of updates in recent years that I can remember. I remember a few years back, they limited how much you could deduct for meals and entertainment. You used to just be able to deduct all the money you spent on meals and entertainment for your business. Well, I'm guessing the IRS likely said to themselves, okay guys, we can see that you're gaming the system here a little bit and you're stretching it. So now you can only use half of your meals and entertainment expenses to deduct on your tax returns. That was an update at one point, I remember. At another point, I remember the IRS eliminated some deductions that they had previously allowed. However, they started allowing corporations to automatically deduct a certain amount of income right off the top. So they're always changing things, they're always making things dynamic with these regulations. And it is very difficult for you to keep track of this. So usually the money that you spend on a really good CPA is incidental to the amount he or she may be able to save you by preventing you from paying too much taxes. You need to decide how aggressive you want to be on your taxes. Because on one end, if you're not, you may pay too much taxes, and who wants to do that? But on the other end, you might be pushing it as far as what you're able to deduct. Finally, number 5, you should keep track of your depreciation and amortization expenses. So the IRS is picky about how they want you to depreciate equipment and amortize certain expenses. And these things change all the time. So I would discuss with your accountant how to handle things like business purchases, asset purchases, vehicle purchases, and other asset management considerations. So, in summary, take a little time to understand how you and your business are affected by income taxes, state taxes, sales tax, payroll taxes, and make sure you give as much information to your CPA as possible about your business. My CPA has a pretty good understanding of the ins and outs of my business because I use the same guy every year, and I've really gone over a lot of things because I want to make sure he saves me having to pay too much taxes by knowing how I operate and what kinds of tax advantages I can take advantage of. Another advantage of keeping up with these basic tax rules yourself is that CPAs sometimes make mistakes. So when you review your tax returns, you might spot a mistake that was made, but you're only going to spot that if you have some kind of at least basic understanding of how taxes work and how they will affect your business. Thanks for watching. I'd love for you to share this video and subscribe and stay up on all the things I'm sharing in this video series. So take a minute and look through my past videos as well. You may find something interesting and applicable for your business situation. Thanks for watching.